Hello, everyone. Welcome back. Good morning, good afternoon to another breakfast hour and something with myself and Jose. It's been a while. It's been a while. We have a lot to talk about, actually. We have a lot to talk about.
Too much to talk about, Neil. And good morning. Good morning to everybody joining us. Like always, we appreciate the support on both channels. So it means a lot. It's been a fun earnings season. Definitely a fun earnings season. And I feel like it's still getting started. We still got so much to talk about. I was looking, Uber down and now back to green.
Uber, yeah. I mean, I was surprised it was down because the numbers were very good. Shopify killed it.
Mm-hmm.
Shopify is up 16% before the market opens. They killed it. I can pull it up real quick, and then we'll jump into Uber. Because the calls, they're all already starting, but it's always prepared remarks first, so we have a little bit of time to go over what we want to talk about. So Shopify, these are basically the figures that we're getting right now for Shopify. So sales beat. The number that the market was expecting was $2.5 billion. That came in at 2.7. Operating income, 291 million. Estimated number was 248 million. Free cash flow, $422 million. And as you can see, has a free cash flow margin of 16%, same as last year. GMV, $87.8 billion, and that was up 31% year over year. As for guidance, they expect growth of around 26% sales growth. The estimated number was 22%. So again, for Shopify, the growth story continues here. As I said here, they achieved 31% revenue growth and 16% free cash flow margin. It's an amazing quarter, amazing execution by Shopify, and the stock is up 16.8%. It's definitely not a cheap name. It's a company worth $160+ billion. So you're paying a premium here for a quality business. That is Shopify. We also had we'll quickly look at Oscr.
Oh man. Just kidding. How's that one doing? It's crazy, Neil. I feel like this earnings season, at least from the stocks that we follow, there were only two directions. It was either massively growth or massive decline. I don't think there was like a chill button in between. maybe Uber seems like a chill button right now. It's only up about 2%, but I think before it was down like 5%. So it's pretty. Um,
Yeah, and it
it's
doesn't
just
make sense. Like when I
yeah.
saw down 5%, I was like, well, that doesn't make any sense, and you people are going to understand why. So Oscar down 2%. Now the thing with Oscar is that we already got the preliminary numbers a week or so ago, so it's not that shocking to see these numbers right here. Medical loss ratio did increase by a significant amount, as with every other company out there, but sales came in weaker than expected, 2.86 billion compared to 2.92 billion dollars. EPS a loss of 89 cents. Expected number was 83 cents. Memberships were up 29% year over year. As for guidance, we know the guidance for the full year, $12.1 billion, beating the estimated number by a tiny bit. Now, I'd say the most important here is this. We believe the market will stabilize next year, and we expect to return to profitability in 2026. Now, they will probably talk more about all of the business and the recovery in the earnings call. More specifically, maybe they get the question about their 2027 goals, if that remains the same or not, or if anything changes right now. But that we'll only know after the call is over. As for the medical loss ratio, this is basically the explanation here. The increase was primarily driven by an increase in average market morbidity that resulted in an increase in the net risk adjustment transfer accrual, which again is the same explanation that we've got with all the other players out there. So they're all will have to adjust in 2026, adjust their pricing and all of that for that medical loss ratio to come back down, which
But
previously was
Neil,
very low.
can you explain that a little bit more to me? Like, what happened in 2025? Is it
So
a
I,
shift in something legal, or just people become extremely unhealthy in 2025 versus 2024? That they did a lot more
apparently,
doctor visits and stuff like that.
apparently it's a mix of everything. It's a mix also of backlog from all the way from 2022 pandemic time, and now all of these companies have just miscalculated and mispriced the amount of well the amount of people that might need medical attention, the amount of unhealthiness as well, plus again a backlog. So it's not a apples to apples comparisons, but remember when ASML's percent market from China went from the 20s to the almost 50%, and then it went back down. So it's a bit of the same, but here in this case, if you don't price accordingly, then you have a case like 2025 where you're going to get hit with high medical costs. And as a insurer, if that happens, well, you're screwed
Is
basically.
is this
But
something? Has this been similar throughout the whole ecosystem? Like, I guess United Health, right? Do
yeah,
they?
yeah, everyone,
Okay.
yeah,
Yeah.
they're all experiencing the same thing. But again, it's a fixable problem. You fix the problem by raising your prices, by adjusting.
Boo.
Yeah, that's the thing. You have to adjust accordingly. Now people will think, oh, but um, screw them. They will raise the prices. They want more profits, but it's a whole funnel. Like they
Hmm.
raise their prices because someone else raised their prices because someone else didn't adjust their prices, and so it's a domino effect. Like everyone has to fall in line in order for this to make sense. Um, Oscar being smaller here, being more tech based, you would think that they should have predicted this or not. But as you can see, their medical loss ratio previously was 79%, which is lower than the United Health in good times as well. Um, so if they said they can get back to profitability in 2026, we don't know when, back half, mid, we don't know. And if they will tell us that 2027 guidance still remains unchanged, then I think we're fine. Again, these are fixable problems. Same with United Health. You fix the problem by raising your prices. And of course,
We got to
you have
find
to
what's the
adjust.
company that's providing all these healthcare companies with this data and short that company. That one's completely wrong, it seems, on what the market was expecting.
I mean, I don't know if it's a company, but remember the market data that we got, right? The labor data that we got was also completely wrong. uh, so that's Oscar. I'll dive a little bit deeper maybe throughout the day, but we have Uber. Let
But
me
just maybe a final thought there, Neil. I know you had Oscar as like invest a little and kind of do due diligence
investigate. Yeah.
throughout. Yeah. Um, thoughts here. Is it more of like what you earnings results from what you see right now? Is it more of like, are you leaning more closer to a hold position? Are you leaning closer to a sell position? Are you leaning closer to maybe dollar cost average more position after what you see on top levels here?
Yeah, so right now, I mean, I'll still have to listen to the call and the commentary to
Hmm.
see if I want to add more. I'm not selling, so it's
Hmm.
between hold or buy more. I mean, the stock is down 2.3%. It will move a bit more as we go through the as the market listens to the earnings call, but it's still in the investigate uh,
Investigate phase. Got it.
yeah phase for now. It's not. It's definitely not in the selling one. Um, Uber Uber did have an amazing quarter. Uber did have an amazing quarter. We're going to jump into the earnings call in a bit. They also did announce a new $20 billion share repurchase program. Why is that? Well, because they are a free cash flow machine right now. So their trailing 12 months free cash flow hit a new all-time high of $8.5 billion, and they remain committed to driving durable, profitable growth. Now,
Nice.
we do have even more information here. So apparently, 30% of eligible mobility riders have never tried delivery. There is upside there. 12% of delivery gross bookings were generated via the Uber app. And now in the Uber app, you can have your rides, your eats, shops, and
I
all of
always
that.
thought it was stupid that they had two apps for
Yeah.
it. I mean, for a long time, even though there had two apps, you can still. For the longest, I've always ordered from uh, delivery from Uber Eats, but you can
Mhm.
see how it's changing. Uh, Pretty interesting. I like that.
Yeah, I mean, why not? Like, why
Yeah,
make people download multiple apps? Uber One, which is their subscription uh, product, 36 million members. So again, 36 million members that pay a recurring fee. Over 40% of combined delivery and mobility bookings do come from that. So that's great. There is of course a lot of upselling, and then I guess a very good slide here. Uber is leading the commercialization of AV technologies. So they have now 20 partners across mobility, delivery, and freight. That's up from 18. There are 12 cities with live mobility and
nice.
or delivery deployments across 3 countries. There are approximately 5 additional cities with mobility deployment expected in 2025. And there are over 4,000 delivery merchant storefront. And of course, this is the new Lucid Neuro and Uber vehicle that they announced a couple of weeks or so
Doesn't look
ago.
bad for a van.
No, it's a luxury. It's a luxury vehicle. I mean, I don't know how much that costs, but Lucid reported yesterday, and they're still losing a boatload of
Lose
money.
money
So
for each sale. Yeah, I
yeah,
saw that too.
so yeah, but this again shows that Uber is well positioned. All in all, monthly active platform customers up 15% year over year. Monthly trips per monthly actives up 2%. Trips are up 18%. So this is still a company that is growing
Yeah.
quite rapidly, even at this scale. Remember, last quarter, people were freaking out that gross
Hmm.
bookings were down. Now we're up
That's
18%.
crazy. Nice amount.
Yeah. So I don't know. People, I
And
mean,
I
freak
mean,
out. It's,
yeah, I think as well because I mean, what seasonality is there? Anything in quarter two that gets you? I guess it might be spring break season. Um,
it's
to
just a
to get
general
you a nice
trend
jump. Yeah,
recovering
but a
also.
nice jump. Yeah,
Revenue up 18 on a constant currency basis. Adjusted EBITDA up 35%. I
I
mean,
definitely want to look at the segment details here. Yeah,
yeah, so mobility is gross bookings 23.7 billion. That is up 18% year over year. Revenue there 7.2 billion. Adjusted EBITDA $1.9 billion.
up 8%
Deliver,
deliveries.
delivery 20% gross
Nice.
bookings.
Adjusted EBITDA is getting bigger too. That's percentage wise.
Yeah. So again, with Uber, it's and then freight is always like an extra thing
Yeah,
here that
yeah. This
nobody
one's
really
always
pays.
like, oh, I forget this is here type
Yeah,
thing.
it's like the Google network. It's like it's a
but
business,
but
but it's not a
it's
focus.
getting to adjusted probability, right? It's getting there. It's becoming 0.5% now.
Yeah, I mean, we'll see what happens with their Aurora investment, right? The autonomous truck company. We'll see if that can change things. But yeah, all in all, free cash flow for the business in the, I think it was over I think 1.9 or something $billion. The business is doing exactly what it should be doing.
Hmm.
Now, let's see. I'll check real quick where they're at in the call. They're already in the question segment, so we can join that real quick.
Yeah, the Q&A session would be probably cool.
Hi, good morning. Thank you for the question. Dara, maybe a great time to follow up on those AV comments you just made. And I wanted to dig in a little bit on the Lucid and Nuro partnership that was announced. There were some investor concerns that this partnership in particular with the capital around it was a negative read-through for the relationship with Waymo, and then also just capital intensity, a little surprising for marketplaces. Could you maybe speak to why this might not be the best framework for thinking about that partnership? And then some high-level thoughts on how you're envisioning owning some of the AV assets versus divesting them to fleet operators, and how investors could expect to see this play out over the next several years. Thank you.
Yeah, absolutely, Mike. Michael, listen, we're very, very excited about the partnership with Nuro and Lucid. Nuro is a leading software player, obviously, excellent management, and Lucid as well, one of the leading EV manufacturers out there with great tech. So we think it's terrific. Listen, I've said it before, we are a supply-led company. The more drivers there are in the ecosystem that we can amalgamate with our platform, the better our service becomes. And that applies with robotic and autonomous drivers as well. So we are absolutely investing in the software players and the hardware players to bring that to fore. And the fact that we are able to work with Nuro and Lucid speaks very well to AV supply going forward. The more supply there is, both humans and AVs, again, the better our platform is. And I think from our standpoint, the good news is that, as you've seen with our cash flow and our capital allocation, we can afford to invest aggressively in the autonomous space and at the same time to return plenty of capital to our shareholders. So it's not an either or. I do think that you will see us do more deals like Nuro Lucid in the early days of autonomous as we're proving out the economics of the marketplace. How much can one of these cars make? Now, the signal that we see with Waymo is based on the trips per day being at a 99th percentile in terms of utilization. That news is great. So once we prove out the revenue model, how much these cars can generate on a per day basis, there will be plenty of financing to go around, third-party financing. We've talked to private equity players, we've talked to banks, et cetera. And while it will take some time, we're very confident that these assets are going to be financeable. And for us, we believe it's a competitive advantage for us to be able to use a relatively modest part of our cash flow to fund kind of the catalyst, get things started here. So we think it's great news. We've got obviously something to prove to shareholders. We always do. But I think it reflects kind of the catalytic potential that we can bring to the market. Anything you want to talk to, Prashant?
Maybe just to remind folks, as we've said in the past, that as we think about our investments in AV, we want to think about them in terms of where will we use capital to take equity positions in some of the software players or ecosystem players to help them kickstart their development, and where does Uber being part of their cap table sort of add to their credibility. We're going to continue to recycle some of the proceeds from the minority stakes that we had to fund some of those investments. You've seen us do that already, and expect us to continue to do more of that over the coming quarters. Second, expect us to use some of our cash flow in a more capital structure, as we may need to invest either in real estate, in facilities, or as we announced with Lucid, actually in vehicles. exactly as Dara said, this is really to help us build our learning base and to build enough information for us to be able to engage more credibly with financing partners, having run these at scale ourselves, and then be able to bring them into the fold with real data on how they can earn a return in this space. And then lastly is obviously AVs today are not profitable. That has been a pretty consistent investment approach for Uber. Is we go into markets and go into products starting at a loss. We build scale, we build our experience, and then over time, we know exactly the levers that are necessary to turn to get that to profitability. You've seen us do that in multiple growth bets, as well as in the delivery business when we started, and expect that to be the same for AV. I'll just call back to, we announced a $20 billion authorization today, in part to make it clear that returning the cash generated from this enterprise to shareholders remains our number one concern. And so the investments that we're going to be making in this area are going to pale sort of in comparison to that.
All right. Thanks for the question. And can we get the next question?
Next question comes from Justin Post with Bank of America. Your line is open.
Great. Thanks. A couple more questions on AVs. In the letter, you talked about we are increasingly focused on broadening OEM partnerships. So really, maybe talk about that and your partnership pipeline here for the next 6 months or so. And then second, with a lot of news about Tesla expanding, how do you think about that? And maybe just give us an update on your share and growth in the San Francisco and LA markets. Thank you.
Yeah, absolutely. So Justin, in terms of OEMs, what we're seeing is that the development of software, actually AV software, has really been accelerated based on these larger AI models. There are some approaches that are kind of perception models, interpreting the world, and then prediction models that decide what to do. Some players like Tesla and Wave, for example, are going with single models. But whatever the approach is, it is really accelerating in terms of time to market. And we actually think the harder part of commercialization is going to be hardware, bringing on hardware platforms and hardware partners that can build these platforms at scale affordably, because today, at least, AV vehicles that are able to be deployed at scale are pretty expensive. We've obviously made the Lucid announcement. We are talking to all of the major OEMs in the space, and we're confident that over the next couple of years, we will have OEM partners. And again, because we bring a ton of demand, we've got a great balance sheet that we can invest, in order to prove out the financing of these models. We think we're in a great position to do so. So stay tuned. You'll see more announcements with OEMs. And then there are certain players like Baidu who also have established not just software platforms, but also hardware platforms that look to be effective at scale and quite affordably, which is terrific. The Apollo Go is one example of that. And then in terms of Tesla, listen, we see them on the streets right now. The deployment that we're observing is very, very small. So we haven't measured any change in terms of trends, both in Austin and or San Francisco. It's something that we'll watch. And again, we said it before, this is a very, very big market. There will be no winner take all. And I think you're going to see a lot of experimentation early on with lots of different models. Waymo's working with us. Waymo is going direct. Are working with a number of other players. You'll see a panoply of models. But we are confident that based on our platform, based on our ability to balance kind of supply and demand, peaks and valleys, we think we'll be the leading third-party platform out there. And with a market that is going to grow and expand the way AV promises to, I think we'll be a winner, but we won't be the only winner. Can we get the next question, please? Thank you.
Next question comes from Doug Anmuth with JP Morgan. Your line is open.
Thanks for taking the questions. I have two, one for Dara, one for Sean. Dara, just in terms of mobility, how are consumers responding to the pricing growth deceleration just tied to the moderating insurance pressures? And I guess what gives you confidence in U.S. mobility trips accelerating in 3Q? And then Prashant, is there any more color that you can add around the buyback and just kind of loosely how you think about overall time frame, just given that the $7 billion from a couple of years ago kind of started somewhat slowly. It's ramped more now, but any more color there would be helpful. Thanks.
Yeah, Doug, in terms of, I'll answer the first one. In terms of the response of pricing, it's been really positive. So there is a sensitivity to pricing on kind of a session level, right? If someone sees a ride for $20 and then sees a ride for $17, the conversion on those two sessions are going to be different. But there's also the person who saw the $17 ride has a greater proclivity of coming back to us 2 days later, 3 weeks later, et cetera. So there's kind of a delayed reaction to pricing, which we're now able to, with some of the data scientists out there who are really terrific, we're able to measure. And that's exactly what we're seeing in the U.S., which is if you measure kind of bringing prices down, and I think the good news here, to be clear, is we're just passing on these insurance savings. So our profit per ride in the U.S. is up on a year-on-year basis. This is, it's insurance money passed right to consumers. What we're seeing in the U.S. is that there's some session benefits or in-session benefit, but there's a delayed benefit to consumers then coming back to the app more. And that's absolutely showing up in July, where transaction growth accelerated nicely versus Q2. And our expectation based on our being able to continue to pass on insurance savings for the balance of the quarter is that the same trends are going to show up in the balance of the quarter. The trends generally are getting better as the quarter progresses, which gives us confidence in Q2, and hopefully that'll continue into Q3, and then go into Q4. Prashant, you want to take the next one?
Yeah, thank you. Thanks, Dara. So, Doug, maybe a couple points on the buyback to help folks understand how we think about it. As this business has inflected and we have started to generate meaningful cash flow, returning that cash to our shareholders is a key priority for us. We've already executed over 60% of our authorization from last spring when it was originally authorized. So today's $20 billion is in addition to the roughly $3 billion that is yet to be executed. So I know that sometimes folks get confused on that. So think of it as $23 billion to execute over the next couple of periods here. That represents about 12% of our market cap, and really is a reflection of how great we feel about the cash flow generation that's in front of us. So if you look at our history now, we've been allocating around 50% of our free cash flow to buybacks. I think that's a fair sort of way for you to think about how we will execute the capital return over the coming years. That gives us also a good sort of way to benchmark how we want to design our programs every quarter. So you should expect this to be sort of a multi-year plan. We will be active every quarter, but of course we always reserve the opportunity that if there is a meaningful dislocation, we're going to get very opportunistic in the market. And just a reminder that we made a commitment last year in our Investor Day that we were going to turn the curve and start reducing our share count. And now in the second quarter, we've actually taken share count down 1%, and you'll see that trend continue for the next couple of years. Next question, please.
Great. Thank you both.
Next question comes from Ross Sandler with Barclays. Your line is open.
Great. This is probably for Prashant, but could we put a dollar amount on the vehicle commitment from these OEM partnership deals over the next few years? Or is there a framework that we can think about this? Is this hundreds or thousands of vehicles per partnership? I know the Lucid deal had that 20,000 vehicle commitment. Like how much do you think Uber will be taking on of that 20,000? And then the second part of the question is just, it seems like the Waymo partnership is more of an asset light version of this. So how important is expanding with Waymo in new cities beyond the 2 that have been announced? Thank you.
Thanks, Rob. I'm going to take the first part of that, and I'll let Dara take the second part of that. I think probably the best way to think about the investments, going back to I think what I said for Doug earlier, is we are committing that at least half of our cash flow generation over the coming years will go to share repurchase, and that's sort of the message we wanted to send with that very strong $20 billion share repurchase. We will recycle the proceeds from our minority stakes as best as those are opportunistic to allow us to fund some of the equity investments in our AV players. So for us, what we've concluded is a modest redeployment of our free cash flow makes a big difference for the partners that we are working with. So I would think more about the impact that we can create with our partners, which is outsized, reflective of the amount of cash flow we're generating. So I don't want to give you a size on it, except to say that you should be comfortable that a lot of our cash will continue to go back to shareholders. As Dara mentioned, I think earlier, that, or he might have been on CNBC this morning, that we will always continue to look at inorganic moves that make sense for us, like the Trindle Go deal that we did last quarter, which has been great for us on growth. And then beyond that, that leaves us some capacity to continue to help build out this ecosystem. And then with the question on Waymo, I'll let Dara take that one.
Yeah, absolutely. So in general, in terms of Waymo, Ross, really our focus is making sure that we're executing incredibly well on the deployments that we have now, both in terms of Austin and Atlanta, and both are going really well. We would love to have more Waymos on our platform, both in Austin and Atlanta and in additional cities, but I don't want to comment on, when and if that's going to happen. But clearly, it's something that our consumers love, and clearly the Waymos on the Uber network are very, very busy and producing economic value. And so hopefully, we certainly know we're going to expand in the cities that we're in, and hopefully we'll have more to tell you over a period of time. In terms of the specific business model, again, I don't want to comment on that, but I will tell you that we see kind of 3 different business models coming in generally, depending on whom we're working with. There's going to be what I would call the merchant model. And under a merchant model, we will essentially pay a partner a certain dollars per trip per day or dollars per day. And so the partner will have a kind of revenue that is very, very predictable. And we will take the risk on monetizing our network. And again, we have more demand than anyone else, so we will be able to, I think, sign up for revenue levels that other people just can't. So the merchant model really kind of creates an advantage for us. Then there's an agency model. Agency model, think of it as a rev share. It's kind of the model that we have with our driver partners now. Driver takes a certain percentage, we take a certain take rate as well. And you essentially have a revenue share based on, and if you do well in a market, that's great. If you do less on a market, it's kind of risk sharing. Then there's another model where we might, or financing partner might own the assets, and then essentially, you're buying cars, and then there will be a licensing model as it relates to the software. So there'll be a certain, whether it's a monthly licensing or per mile licensing, you can imagine lots of different models out there. So those, I think, are how the marketplace is going to shape up. I think you'll see all 3 of those models in our marketplace over the next 5 years. And it's going to depend on really the needs of our partner. But we're very confident as to being able to kind of build the most robust economic and operational ecosystem as it relates to AV within the Uber network. Anything to add, Prashant?
Yeah, I think, Ross, maybe just circling back to the first answer I gave you, one element I probably should have added is I wouldn't conclude that by purchasing vehicles, the economics are going to be worse. In fact, our our analysis is that the Neuro-Lucid deal will probably yield better economics for us because of it's a collective deal, and we just get the efficiencies of having the vehicle and having the software integration in there. So our view is actually we're probably going to do better on that from an economic standpoint.
Thank you.
Operator, we'll take the last question.
Thank you. Your last question will come from Benjamin Black with Deutsche Bank. Your line is open.
Great. Thank you for taking the questions. Dara, you mentioned the barbell strategy within U.S. mobility. I guess when you look across the spectrum of opportunities across the curve, where do you see the greatest incremental opportunity for mobility in the U.S.? Is this more sort of on the lower priced offerings, or is there still a lot of room to run on the higher end as well? And then can you dig a little bit deeper into your comments around externalizing your technical capabilities in the letter? Are you talking about data licensing opportunities within AV, and if so, how big could that become? Thank you.
Yeah, absolutely. Ben, I'd say in terms of the barbell strategy, it is both. It is low cost and premium. I would say that premium is easier to execute on. There is clearly a consumer want in terms of paying more for higher reliability. That's essentially what the Reserve product is, and or paying more for a nicer car, which is kind of the premium product. I would also say that our Uber for Business is also growing nicely, over 30% on a year-on-year basis. So I think premium near term in terms of profitability has higher potential, call it over the next 3 years. The lower cost product is a harder product for us to pull off, and because we have to kind of drive efficiency across the network. And one of those instantiations is Wait and Save, where you accept lower reliability and as a result are able to pay less, or our Uber Share product, where essentially you will take maybe a longer ride, maybe a little bit of a detour, sharing a car with someone else, and again saving money on that. The lower end product, I think, ultimately is kind of the greater opportunity in terms of trips, in terms of TAM. But over the next 3 years, our lower end product is costing us a margin that we think is appropriate in terms of the investments that we're making in our future. Expect us to continue on the barbell strategy. You'll see similar things as it relates to our delivery business. Priority delivery, paying up for priority delivery in order to get your delivery faster, or accepting some delay in your delivery, and again, saving some costs. So this barbell strategy is something that we're using both in mobility and delivery, and they both carry significant promise there. In terms of externalizing our tech capabilities, this is something that I'm really excited about. And just like a really simple example is our advertising business and our direct business. If you think about Uber Eats, there are two pieces of value that Uber Eats brings. There's audience to an SMB restaurant that it brings, and then there's fulfillment capability, which is getting the food to the home. And we separated those two capabilities into an advertising business that's growing incredibly healthy, very, very high margin, and a direct business where essentially we deliver on demand for our customers who may have brought those consumers to their front door on their own through their own app. You should expect to see more of that. So, for example, data collection for AV is absolutely something that we're working on. I say it's not really something that I'm looking to make profits on, but really helping AV get to market faster. And then one area that we're really excited about is kind of one way to look at Uber is it is a platform for work. We've got almost 9 million people who are earning on our platform, and they can earn in different ways other than driving or transporting things. An example of that is actually our Uber AI solutions, which is one of the really exciting parts of our business, growing very quickly off of too small a base, I tell that team at this point. But they are engaging in data labeling, translation, map labeling, tuning algorithms, etc. And these are sometimes drivers on our platform, sometimes kind of specialists that we bring onto the platform. But it's using the core Uber capability, which is sending out tasks two earners all over the world. You're just going to see a different kind of earner that is going to work for kind of the really exciting kind of AI developments that you see all over the world. So that is another example of our externalizing our platform, and we are many conversations with their tech teams as to what else we can do with their platform capabilities globally. So it's something that we're quite excited about. All right, I think is that it, Balaji?
Yeah, let's wrap it up there.
All right, everyone. Thank you very much for joining us. We really appreciate your taking the time.
All right. With that, Uber stock is flat at the moment. With that, Uber stock is flat right now.
Anything that got you that you like from there, Neil?
So he did mention something at the start of the call, which we didn't join, but the 36 million of Uber One, I wrote that in chat. That's growing 60% year over year. So that's pretty impressive. Of course, they probably mentioned something with regards to the advertising business, or maybe not. I don't know. That was probably at the start of the call. We'll get to see that probably in the next 10 minutes or so with the transcript coming out. But it seems like they are very confident and comfortable with the position that they're in, with the cash that they're generating, with the balance of investing in the business, whether it's aggressive investing in AV solutions, deals like the one they've just made with Lucid and Neuro, potential future deals, and also making sure that they are returning value to shareholders through share repurchases. You don't do that if you are in a position of weakness, in my opinion. You do this because you're in a position of strength. I know some people will disagree and they'll say that Uber goes to zero and et cetera, but I don't know, based on the numbers that we've seen, for Uber to go from this point to zero, a lot of bad things need to happen consecutively, which I don't see happening. For the quarter, actually, they generated, I see here, $2.4 billion. So that's $10 billion on an annualized basis of free cash flow for them. I remember the times when people were laughing at Uber for burning so much money.
Much free cash flow, yeah.
Yeah. Actually, let me pull this up and show you the evolution.
Yeah, it's pretty impressive. I mean, the massive shift here in that free cash flow sentiment for this company.
And if we go all the way back here to when they were losing quite a lot of money. So look at this transformation. You go from burning billions to then a flip of the switch here, and you go up, and to the right here to now generating $8.5 billion in free cash flow over the past 12 months. I do have to correct this because I always see this and it's not true. You do share repurchases if you can't get better returns from other business investments. No, you do invest in your business and you can buy back shares. This is what every elite company is doing and has been doing for many, many years. NVIDIA does it.
Perfect. I was going to say perfect
Apple.
example. NVIDIA. Yeah, it's buying so much cash. Sometimes right now you're in a position where you don't need to have where it's better to use cash efficiently. And obviously, there's only so much money you can throw in a project before it becomes inefficient. So there's always a form of diminishing return. It's up to management to determine when that diminishing return starts and when it makes sense. Okay, look, we have all this money. We're not going to put all this money into these coders or something, because then they're going to feel like they get a free lunch and they're always going to just kind of slack off. So you have to also create some urgency. And I think they're doing fine. The worst thing that I would hate is them having so much free cash flow, Neil, and starting to invest in random companies or random ideas that aren't part of their core position. So as long as you continue to see improvements in their core position, then they can do whatever they want with the rest of the cash. And like you mentioned, Neil, you have big players. NVIDIA is the prime example. You think and the AI market is not done, but they're not going to be spending 40 billion a year on engineers just to have, say, we're spending on it. They're going to spend what they think they need to spend, and then the rest goes on buyback and that 1 cent dividend that they give.
No, exactly. Like if a company is growing at 1% and yet they're spending all of their money to pay dividend and share buybacks, I'll agree with the statement.
Yeah.
But if a company is still investing in the business, growing the business,
Yeah.
and they have cash left, so the smartest thing to do is to buy back shares, then that's the good thing. That's the smart thing to do.
Yeah, and I do like this thought from Roberto here. They are in good position to become demand aggregator for AVs and sound like they are ready to be flexible, looking for the right model. And during the call, right, they mentioned the 3 different types of models, kind of like the revenue sharing partnership, or just a direct buying of vehicles and then licensing the software type partnership. And I forgot what the third one was. But it's yeah, the AV market, just, I mean, I think the perfect way to think about it is just the current AI LLM market, right? I mean, we still haven't found the perfect model for AI models like ChatGPT and all this. Right now, we have a monthly subscription basis on them, but I think it's going to continue to evolve over time. And I think it's pretty cool that Uber for this AV market is understandable that it's going to be flexible with however their partners want to go about it, as long as it makes good for both ends of the party.
Yeah, they did say that they talked to private equity players and banks regarding financing of robotaxis. Makes sense. Dara also said that they're talking with all major OEMs in the robotaxi space. So they're making sure that all the options are on the table and they take the right approach. They talked a little bit about their relationship with Waymo. I also like the fact that they have a relationship with Waymo, but it's not like, oh, if we don't have Waymo, then we're screwed. No, it's a good strategy to have all of the options on the table, all of these players out there, and they'll try different things. I think they even said that the move that they're making with Neuro and Lucid makes more sense to them from a profitability standpoint, if I remember correctly, because they of course they invest, they own the fleet, but
I found that one a little bit weird, right? Because you still have to make that, you have that heavy capex investment on buying the fleet itself.
Yeah, but that's
So you
why
become,
they said that they're talking also with private equity players and banks to finance the robo taxis. So you have that.
okay, yeah. So yeah, that's the only one. Because, right, I mean, for me, one of the greatest things about Uber is they've never been a heavy capex player in terms of
Mhm.
owning the assets and owning the vehicles. So I wouldn't want that to shift. I would definitely love to see maybe more of a partnership where they don't take off the debt, maybe a partner takes on the debt, and you kind of do that revenue partner sharing, or however you do better deals with them, where again you reduce that that asset heavy business. Because I mean, vehicles and AI is just going to get better and better. The last thing you want to do is buy vehicles that you're going to no longer need 3 years from now, 3, 4
Yep.
years from now.
Yes, I mean that's the thing. They also said about making sure that making the robo taxi makes sense, like because it costs a lot of money to make those cars. They acknowledge that. So yes, it's more about the underlying tech, making sure that the underlying tech is going to be here for the future, and partnering up with the right ones. Now, with regards to the financing, I think we could see the same that we've seen for example with Meta, right? They also talked about co-financing for some
With the data
major
center,
expansions.
yeah.
Yeah, so we could see the same thing here. And like you said at the start, it's all about having the supply, enough supply. The more supply they have, the better it will be. I mean, if they can control the amount of supply that they can have on the platform, I guess that's going to be good for them. Quickly touching here on this, Uber is already. I mean, Uber is partnering up with Baidu, huge player, Chinese player. Uber is partnering up with Pony AI as well,
Pony AI, yeah.
Chinese
Neil,
slash US.
do they break down revenue segments in their slideshow, or is it I'm pretty sure they
For
do it in their 10Q report for like
for what?
geography, geo,
I
like
think
how much revenue comes from what part of the world.
I don't think in this report, but I think like on a yearly we have that.
Okay.
Maybe on fiscal. Let's see if we have it, and then on fiscal, yeah, but we don't have the the
Yeah. And
updated one just
we're
yet.
seeing questions coming in. So I know some people are asking maybe a quick recap on Oscr. We have Novo. We have AMD. We'll definitely get into them. We'll just finish our thoughts here on Uber, and then I think we can jump into the others.
Yeah, so this is what I have now for revenue split. Let's remove this. But this is not updated for the recent quarter just yet.
Yeah.
So the majority, of course, United States, Canada,
State.
and we have here from Asian markets $5.1 billion out of what was it? 45.
I'm guessing green is Europe and Middle East.
Correct, and Africa, but I don't know how much from Africa does that come from. Probably the most from Europe here. So yeah, Asia is still small. It's been growing at 18% compounded.
Yeah.
Since,
Every market has been growing, at least for the past 3 quarters. Yeah, it's been a nice, healthy growth all around. That's pretty exciting.
Yeah, no, I mean, again, with Uber, the fact that we got the chance to buy this at $60, around 60, because of the fears that this business suddenly will disappear, was laughable.
I do find it wild that the adjusted margins for delivery is positive. The only time I ever use Uber Eats, Neo, is when they give me a buy one get one free, and every day they have something. So I don't know how they make money there with it, because I'm pretty sure they have to give money back to the restaurant or something. It's definitely
Probably
not
ads
the restaurant offering.
also.
Yeah. No, that is true. Yeah. Oh, that's true. They might just sell. Okay.
Ads, economies of scale. I mean, eventually it makes sense when you think of it. Like if millions of people do buy.
But before we go to jump Novo,
no problem.
Neo, any maybe just a quick thoughts on the Oscr again? I know you covered it already, so before we go into, I know there were some people wondering about that one.
Yeah, so according to someone here on the chat who has been following Oscar's call, they didn't change anything with regards to their 2027 guidance, which is very good. I'll make sure I think it was 5%. Okay, so they said we're still targeting 5% net income margins by 2027. We need to get through this pricing season first, but as of now, that guidance remains unchanged. To me, that was the most important one, which also means $2.25 EPS for 2027. Now, these, as you can see here on the screen, these are the numbers for this quarter, which, again, we knew that this was a bad quarter because of the preliminary numbers that we've got a week or so ago. Guidance for the year, still the same as a week ago. And they do expect to return to profitability in 2026. And again, that guidance for 27 remains unchanged, which is very good. I mean, $2.25, while the stock right now sits at $13.43. So $13.43, 6 times 2027, let's call it 6 times 2027 earnings growing that quickly. I don't think that's too bad. That's too high of a premium for Oscr. Now, of course, let's see how quickly they can recover in 2026. It's the same with all the other companies, right? Because United Health as well, they're all expected to come back to growth in 26 once they fix the pricing issue. But with Oscr, I mean, medical loss ratios for Oscr were already lower before. I think we can get back to those low 80%. I'll have to go through the whole guidance and call, but seems like it's been if it's reaffirmed, then that's good enough for me, I'd say. We did have also, if we have more questions here, let's see. Oh yeah, quickly, maybe AMD is down 5%. Okay, so again, the implied volatility yesterday apparently was 7.5%. Wouldn't surprise me if we hit that when the market opens. As for Novo,
I think there were some price targets already.
Yeah, most of them maintained, I think.
Yeah, maintained. There were a few that went up and there were a few that went down, but I think on average was the average still is probably around the same.
Yeah. Gosh, I wonder why. I wonder why that happened. Probably because it was a very good report. Probably
Yeah,
because of
I
that.
still think so.
Any ideas on Nebius? So tomorrow we have Nebius before the market opens. We are going to cover that. I'm very excited for it. I think they knock it out of the park. What will the stock do? Ask Mr. Market. He knows it. But hopefully it crashes so Jose can buy
What are we talking about?
Nebius tomorrow.
Yeah, I'm hoping,
Yeah.
but
So
I don't think my hopes get filled right now.
I think you're right. Quickly touching on Novo Nordisk. So stock is down another 3.5%, it would seem, right now. Yeah, 3.7, 3.5%. So they report in Danish kronen, but they also tell us here on a constant exchange rate. So sales increased 16% or 18 on a constant exchange rate. Operating profit increased by 25 or 29%. Obesity care sales were actually up 56%. So the big growth driver here is still growing quite nicely. Now, of course, this is what has happened in the past 3 months. We also know what they told us with regards to guidance, which for the year is not that great. Novo Nord, what is Novo Nord? Novo Nordisk is a Danish company that makes, for example, the Ozempic, the things
Fatskin.
for weight loss, diabetes products, solutions, I'd say.
They give you the problem and then they give you the solution.
Yeah, so not a
Infinite
Russian,
growth.
a Danish company. So they say your diabetes care sales increased by 6% or 8% on a constant exchange rate. Diluted earnings per share increased by 23%. They do talk about the Wegovy US market challenges, the strategic shift, all of it that they basically talked about last week when they gave us that July that update for the year. They did say that I think their oral solution is expected to, let me see if I wrote it down somewhere. I think it's something for later this year. International sales were up 19% on a constant exchange rate. Rare diseases up 15%. Let's see if I can find that info. So, okay, regulatory approval for the oral Wegovy by the end of 2025 and launch as soon as possible. The thing with all of these companies is that you have to make sure that your pipeline is robust, especially compared to the competition. You have to protect your patents as well, which is something that Novo did not do, especially not in Canada. And you need to make sure that whatever you're making next, which in this case is the oral solution here, because every other company out there is also trying to have an oral solution, the results might not be as good as the injection ones, but you don't have to inject yourself every single day. It's just a pill that you take, which of course is better. Then you have to make sure that people don't get nauseous, don't get sick, and actually lose weight. So the decline in Novo Nordisk actually started late last year when their results came in a little bit lower than what the market was expecting, but still in line to what the company was expecting. It didn't come in lower because financially they weren't doing right. The downtrend started because of results of a specific product. So the pipeline here is important for them, is important for every company. Tomorrow, I think Eli Lilly actually reports, which is the major competitor. It's going to be interesting to see what they tell us. As for guidance for 25, same as last week, basically. Sales expected between 8 to 14% on a constant exchange rate, much lower than the, let's call it 15% or so, 16% at the midpoint previously. The lower guidance reflects a more conservative outlook for the second half, primarily due to challenges in the US obesity market and select international ones. I think it's cheap. I think it's cheap. Do we buy it here for a quick recovery play? A quick one, forget about it. A recovery play is possible. Yes.
For a recovery play, Neil, which one do you like better? Well, I guess you already have, but
yeah.
My question is going to be United Health for this one.
Yeah, if I had the cash, I wouldn't mind opening a position for Novo as well. But I don't want to stretch myself too thin because I still want to focus on the other two names that I have. But again, this is a company that is still growing, still expected to grow. I think their guidance is quite conservative. And so, yeah, stock seems to be bottoming at around the mid 40s or so. It's very, very oversold at the moment, but it's not going to be a V-shaped recovery. Is it going to be a market-beating return from here? I do think so. But yeah, you just need patience with this one. So.
And Neil, I wonder if we can go back to fiscal.ai to see what the AI summary was for Supermicro. Let's see what they kind of discussed during earnings. I know that stock is down about 15%. We looked at guidance yesterday, right, during the earnings, and it definitely wasn't that exciting from what they thought it was going to be just a few quarters ago.
Yeah. Quickly here from Mel. Oscr is expected to return to profitability as soon as 26, correct. Also implied new acquisition to launch new health products and the ICHRA plans. Okay. I'll have to go over the call, but those are definitely positive comments. Duolingo, I think, reports after hours today, but we're not live later today. So
yeah, Duolingo after hours today. Yep.
Yeah. Supermicro down 16% or so. Let's see. Any questions you want me to ask, or just the major overview?
No, just a general. So it's just saying, I mean, net sales, 22 billion, but it's still, I think, missed. I think later on they might talk something about some of the bearish sentiments there. If you scroll down to the gross margin decline, maybe we can ask that in a bit of what happened with gross margins if they discuss that.
Probably again product mix or something.
Yeah. Guidance.
SBC. Let's just ask what went wrong.
Yeah.
Dum dum dum.
What went boom boom boom? It's Supermicro. You've seen their
revenue shortfall.
8% year-over-year. That's crazy, right? I mean, I think it's getting punished accordingly. The revenue shortfall stem from two key factors: a capital constraint that limited the ability to rapidly scale production. But I mean, they had all this. I feel like they just keep doing, what is that? Senior notes or offerings. How are they still? The capital constraint will no longer be an issue after we filed the fiscal year. Okay. This is combined with higher. Yeah, gross margins definitely sucked again.
Gross margin sucked. It's not $40 billion 26 guidance anymore. It's 33, so that's $7 billion less.
Which is wild to me. I mean, it is definitely wild.
I mean, from a valuation standpoint, it's I guess cheap-ish, but then again.
Mm-hmm. And again, this is going to be the story of once we get Dell and HPE to tell the story. Is it a Supermicro problem, or is it an industry problem, at least here for some of these server solutions? And I think it's going to seem more like a super micro problem than a Dell and HPE problem.
Yeah, so revenue growth is decelerating, but should reaccelerate next quarter if they do reach their those targets.
I wonder if they haven't gotten much Blackwells, even though the Blackwell has been out. The B200, B300, the B200 and B100 have been out, but it doesn't seem to be helping them.
No, I mean, revenue has been stagnant for a year almost.
Shopify up 14%, pretty cool. Not sure what this person's saying, so it might be weird. I didn't feel like reading it before posting it, so kind of off topic. As an 18-year-old, I invest in companies I feel as though have good financials and a bright future. How do I go about sizing each position apart from market cap and conviction? I think I would say eventually you start to build your own type of portfolio allocation list, of saying, so what I like to do, Neil, is I have like a tier system. I have like a tier 1, tier 2, tier 3. Companies that are considered tier 1 can go over 10%. Tier 2 can stay between 5 to 10%. And tier 3 are usually those yellow plays that usually stay in the low singles. So, I mean, maybe creating like a tier system, but that's pretty much just conviction as well. But a tier system goes a long way. Starting at 18-year-old, I want to say congratulations on getting into investing pretty young. I wish I started at 18. I started at like 21, I think. So a little bit over 10 years ago. But yeah, you being young, you're just going to learn through experience, I think. And it seems like you have the great mentality. So just continue with that.
Yeah, I guess the thing with starting off early and young is that you start off with a small amount. Unless you're a billionaire, we don't know. But you start off with a small amount, so whatever mistake you're making, it's just a small dollar mistake. And the more mistakes you make early on, the fewer bigger mistakes you'll make later down your investing journey.
Yeah, agree. I'm happy I made a lot of my mistakes when I only had like a few thousand here and there in the portfolio. Where it's like, it sucked at the moment seeing 50% drop, but it's like, compared to now, that's
right. Yeah, I'd rather lose $500 than $50,000.
Yeah, exactly.
Plus, books can only teach you so much. Right? You can read all the best books, but the moment you put your own money into something, no book can tell you what to do. It will be about your brain, your stomach, and your strategy, which eventually all three will work well together. Quickly touching here on Disney, they also reported revenue up only 2%, but free cash flow was up 53% to $1.88 billion.
Damn.
Free cash flow is a metric. I mean, I don't own Disney, but free cash flow is the metric that I would follow for them, because free cash flow was also thrown out of the window, I think, a year and a half or so ago. But it seems like that's returning and doing quite well. I do also believe they had a big announcement with regards to ESPN and WWE for the rights of it, and something with NFL as well. So they're making, again, big moves with regards to, with regards to media. Let's see what we have. Yes, so they just announced the plans. So the Walt Disney Company, the company is taking major steps towards streaming with upcoming launch of ESPN's direct-to-consumer service, our just announced plans with NFL, and our forthcoming integration of Hulu into Disney Plus, creating a truly differentiated streaming proposition that harnesses the highest caliber brands and franchises, general entertainment, family programming, news, and industry-leading sports content. So
I feel like
they
Disney is the new cable.
Disney
right?
is
That's what they're trying to do.
on-demand.
It's gonna be like, it's gonna be, you get Disney, Hulu, and ESPN. You're paying what, $50, $60, $70?
No, but
probably.
they package it in one thing now.
Oh, okay.
Okay, ESPN is a standalone thing because it's sports.
Yeah.
sports only. Again, I would understand people that only want sports and not anything else.
How could you not want Star Wars?
Because the newer one sucks. I don't know.
Calm your mouth, Neo. You're threading in thin water right now.
No, let's be honest. The newer one sucks. Andor is very good, though.
Or thin ice. I don't know what not thin water, thin ice.
Yeah, I don't know what thin water means, but did you watch Andor?
Yeah. Well, I'm watching it right. Season 2 with my brother right now. So
That's a good show.
I lack a little bit.
But yeah, this is free cash flow for Disney last 12 months, though. So we see a nice recovery here for the business. So that's so that's good. Let's go back to the advanced something
money,
depending
advanced
on
money. Yes, put your own D here. Your thoughts betray you, Couch. I agree. Roberto, see, I like Roberto.
I like Roberto too. I just don't like the new Star Wars. What did I want to check?
AMD. So, I mean, I think here, short term, anything can happen. I think long term, I still am with the multi-bagger opportunity here for AMD. I mean, I think quarter 3 is when it starts. That data center really starts. They mentioned it. It's massive ramp up. I mean, if they said data center is going to see year-over-year growth in quarter 3 in the second half. Quarter 3 and quarter 4, if we kind of look at them, Neo, for if we can go to segments,
double digits,
KPIs, double digits, yes. So if we look at segment KPIs here for quarterly, and we look at just the data center revenue, the peak for data center revenue for AMD was quarter 3 and quarter 4. Quarter 1, but quarter 3 and quarter 4 were pretty strong, especially quarter 4 was the peak. So if you're seeing double digits on just those two, that's, I mean, we're going to see, I think we can definitely see 4 billion in revenue, at least one of those 2 quarters. And that's going to be a nice sequential growth and a nice year-over-year growth.
Yeah, I mean, I've seen some people complain, oh, it's only growing 14% when the whole market is exploding. AMD is garbage. I was like, they explained it like 10 times. Why it's down.
To be honest, MI300 sucks. It does. It was their entry level. It was their starting up. But they mentioned M3 during the Q&A session. And my apologies to those who are watching and were looking for my thoughts after. I had to go take the little one out, so I couldn't stay. But for last night's stream,
he saw the stock drop. He didn't want to show his face. That's why.
Yeah. But there was a question after I read the transcript, Neil. It was like, what is your biggest surprise for the MI355? Or what were some of the changes in the way the market was moving with it? And Lisa Su was just the rate of adoption with it is a lot faster than they expected. I think Lisa Su was a little bit more bullish than normal. Again, she still didn't want to give us those damn numbers, even though everybody kept asking, oh, 7 billion next, blah, 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 8 billion, 10 billion.
2 billion run rate. The last guy.
What is this?
And the last guy's question was, the answer was very strange. Like if I go, like they suddenly stopped. Like he asked here, and then if indeed that gets you pretty close to a couple $2 billion, if the MI300 comes in, do you see that at the same run rate as you exited? Then you have the ability to get the $800 million run rate again, blah, blah, blah. Then you got here the answer. It will take time to ramp up, particularly today. I mean, we're sitting already in early August, so I don't think we'll see this in Q3, but certainly as licenses would be approved, we would schedule that and would take a little time to ramp up. Then boom, okay, right, operator, thank you very much. It's like,
yeah,
abrupt.
I feel like they have a lag sometimes in their system, and that might have been it. But yeah, but that was for the 308, right?
That was, yeah, the last one was a 308. But the same analyst asked the question before about the $2 billion run rate for GPUs without China. So gives us $8 billion for the year, which is not great, of course, comparing to what we were expecting. But Gene said here, if you look at the sequential revenue increase, we see data center a strong double-digit increase, which include both GPU and CPU. So again, they don't want to separate the
What
numbers.
is strong double digits? What the heck?
Yeah, but GPU definitely drives the largest incremental amount.
Is it 50%? Is it 22%? Is it 38%?
Because now it's 14%.
We got to see, what do they consider strong? 14%. If they say 14% isn't okay, then
I mean, let's say because it should be higher than 14 because it needs to be an acceleration of growth. Unless I'm wrong.
Was there any comments on this, Neil, during the live stream yesterday?
Yeah, no, I mean, when it ended, I was like, that last part, and everybody was like, yeah, that last segment was very, very strange. Like it's as if they were like, okay,
we're out of here.
Like we're done. We're done. Plus, I said it yesterday. I don't like it when analysts ask questions and we don't get a straight answer or not even a semi-straight answer. Like, I understand you don't want to give new guidance because every new answer you give is basically guidance, specific numbers and all of that. But I don't know, at least give us maybe a range or something to work with. But yeah. So double-digit growth for next quarter data center. We go from 14%. It has to be it has to be closer to 20, no? Or not?
I would hope so. I would say higher than 20, at least 25. Strong would be at least 25.
But 25 is a huge increase.
Yeah.
No, but it would make sense because they are guiding for $1 billion more in revenue.
But
overall.
Yeah. And
overall,
they mentioned something about the gaming market. I think the gaming market was going to be down.
No, flat.
Flattish.
Flat, which is still strong compared to where we have been before. If we go to gaming, I mean, gaming is up $500 million. So if it's another $1 billion quarter next quarter.
And yeah, I think Josh, on my channel it was like 73% pump and then 27% dump. I don't know if what was on yours.
I had 63.
No.
No, 43 green. 43 green, 27 red, and then the rest flat.
You had 3. What an extra.
Yeah, you always have to have 3. But do you think this is like the US elections? But you have embedded that's expected to have sequential growth. So that's good. But data center specifically should have double digits. I don't know what that double digits can be. Like if we do, what was it? No,
but Neil, is it double digits year over year or double digit growth from the first half?
That's also a good question. We expect it.
I mean, luckily here the first half looks very similar to the second half of last year, so it's could be around. But I every time they kept saying double digits, I thought it was year over year growth. But there were also certain commentary that made it seem double digits from first half, as they talk about the first half and then the second half. Too many questions. Gotta email them.
Let's say they reach 4 billion. Let's say they reach 4 billion for data center next quarter. So 4 billion, let me pull up client, gaming, and embedded just so we can calculate how we get to 8.7. So 4 billion data center, which means we have to find 4.7 billion from all the rest. We know, based on what they told us, that gaming is flat. So that adds another billion. Let's say a billion.
Yeah.
So we're now at
Okay,
5 billion.
Yeah. So we need 3.7.
We need 3.7. Embedded, I'd say, adds another 900 million because we have sequential growth, they say.
Yeah.
So another
2.8 billion.
2.8, 2.8, 2.9 billion from client. Is that possible? I think so, because that's still expected to grow.
Yeah. 2.8 from there. At least 2.7, right?
Yeah. Because we because we can play around with 100 million here, 100 million there based on embedded and gaming.
Everywhere. Yeah. So 2.7 there, and then the other ones we misestimate 33 million, 25 million on each. Get out and at it. Then I think you need about $4 billion in revenue next year from data center, from next quarter from data center.
Yeah, and that would be
and that's without adding any.
That's 20% increase approximately.
Yeah. 20% increase quarterly.
Year over year. No, from last year's 3.5 billion. Fair to say, no?
Yeah. All right. Then I but that's them. 8.7 was on their mid. The high end was 9.
Was it?
Yeah, it was a 8.7 plus or minus 300.
Yeah, okay.
So their high range is 9. I think they expect more than 4 then. They're not gonna I don't think we see much growth in anything else. Obviously it's just a client. It's got to be driven just by data center market, and they're not going to give us 8.7 if you're only expecting 4 billion in data center. You're going to be expecting more, because I do believe Lisa Su still likes to be conservative. Yeah.
Let's see.
What do you think about tens of billions? I don't know, right? Is it tens? Is it in the 20s, 30s?
Yeah, the analyst asks client revenue. Exceeding market growth. Okay. What it promoted driven by data center. Okay. Some growth in the
AMD is focus.
Okay, some growth is expected from it, so not much. So so probably more, maybe even more than 4. Maybe even more than 4 billion for data center. So that will be a nice acceleration.
Yeah. And the market says, what is going on here? This is really the next blah, blah, blah. Insert AI company here.
Yeah, I mean, that would be interesting, because someone did ask about the tens of billions of dollars in revenue in the future. Like, when is that going to happen, and how? Well,
yeah, we're like 2027.
Yeah, no answer, basically, like circumventing the whole. She went around the campus and is like, no. But yeah, okay, no. If we say 1.1 gaming, 900, so that's gaming and embedded, that's 2 billion. Yeah, okay. 2 billion, 4 billion.
Yeah, I mean, because like they even mentioned, right, gaming, you won't see much growth, I think, in the second half. As if you are, most of the gaming revenue tends to pull up in the first half as companies build their PlayStations, their Xbox, and whatever, and get it ready for the second half of the year, for the holiday season. So I don't expect much growth here from gaming. The embedded market, what did they say about the embedded market, Neil?
Sequential growth.
Sequential growth. So that one can see, okay. How much did they say? Strong sequential growth? Okay, sequential growth.
Just sequential growth. And they said that because they had $14 billion in design wins in 24, they expect to beat that number in 25. So
what is Unity doing today? Did Unity report today?
I think so, no? Or not?
Some scrub named David Silva said Unity with the Uno reverse car. It's up about 7%. Did they release some new AI solution? Achilles, let's say Jose, they give you 3 of your stocks to go all in, go all in one, and they take the rest of your portfolio stocks. Are you? GitLab, AMD, Marvell. What do you choose? So your question is, if I can only go in one and then all the other ones leave my portfolio, AMD for sure. I think AMD is this, out of those, the safest multi-bagger opportunity for me. And if I can only go on one, I would rather go with that. I think Marvell and GitLab are like the bigger growth opportunities if things are successful, but I think the success rate for AMD is a lot higher. So hopefully I got the question right, but that's the one I would choose.
For Unity, the CEO said, we believe the second quarter of 25 will be remembered as an inflection point in the Unity story. So whoever still owns it, I think you do.
Yeah, I think I'm eventually gonna break even on this one.
Inflection
like
point
40.
is happening. Unity Vector is already seeing some positive signs here, driving 15% sequential
50%
growth
sequential growth
in
Jinx.
Unity ads. So yeah, inflection point.
Why can't Lisa Su be using adjectives like this?
Because the stock has already inflected. The stock is already up significantly. Let's see what Oscar, still down 3 points. We have.
What do we have, Neil?
Iron actually gave us the July numbers. Pretty good. So
they reported today or yesterday?
No, it's just their monthly update about
okay.
hardware revenue and all of that. So still 810 megawatt data center capacity, but July revenue was 86 million.
Remind me again, Neil, is Iron closer to Applied Digital or to a CoreWeave?
It's
or is it a mixture of both?
Yeah, it's Bitcoin miner turning into a HPC player. But wait, where are the growth rates? Maybe beneath. Okay, yeah, no. So here you can see the difference. Here you can see the difference. So hardware profits compared to June were at 63.3 million compared to 49.2 million, with hardware profits of 76%. Revenue from Bitcoin mining 83.6 million. That's up from 65.5 million just month over month. And the beauty here is that the costs are basically remaining stable. The higher the Bitcoin price, the better for them. The more Bitcoin they can mine, the more hash rate they also have. They're at 50 right now. The AI cloud services, which is the new business, is at 2.3 million, which doesn't really do much. But yeah, okay. The profits here are insane. But what's very interesting here is a diverse customer mix, contract terms ranging from on-demand to 3 years, including through white label compute with leading US AI cloud providers, Hopper GPUs generating annualized run rate revenue of $28 million, and then Blackwell GPUs procured, initial delivery of 256 B200s already contracted with a customer, with the remaining 1,100 B200s and 1,100 B300s scheduled for delivery at Prince George, their facility, over the coming months. So we already have here 256 B200 contracted with a customer. I don't know who that is, but that's already pretty good and good signs of things to come. Now, yeah, so this is a company worth around $3 billion or so, and if you annualize,
is it $3 billion right now?
I think it's 3. Let's see, 3.6 billion, and the 50 exahashes does generate $830 million of annualized hardware profit. Now, I
I
think
wonder
it's,
what they're estimating on kind of like Bitcoin prices and stuff like that.
I mean, it depends on the
Yeah, but
Bitcoin.
I wonder if they have like a trend that they like to follow.
I mean, they did have a presentation when they showed like what happens. They will still be profitable as long as Bitcoin stays above, I think, $50,000. They can make a profit. So of course, if it stays at 100,000 or more, they'll make a lot more profit. And this is basically the future, right? This is what will make the AI services HPC business into a multi-billion-dollar business in the future. It's all of the megawatts and gigawatts that they would provide in the future.
So when is this one coming out on track? 500.
The first one here?
For delivery. Yeah.
Yeah. So, okay, very, very small first. Then the Sweetwater one, which is 1.4 gigawatts. That's energization scheduled for April 26. We still have some time. Then we have Sweetwater 2. It's another 600 megawatts, and that's just for 2027. But in the meantime, the Bitcoin side of the business is generating, probably going to be, if Bitcoin does stay.
Ding, 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 boom, boom, clack, clack, clack.
Ching, ching.
Come on, you missed the ching, ching. Oh yeah, ching is what we were doing.
The Bitcoin side of the business can generate $1 billion if the price of Bitcoin stays above 100,000. Yes, that's iron. That is iron. Okay. AMD down 6.
See what's going.
Nice. AMD down 6. Okay, so we're at that 20-day moving average.
Yeah. Oscr up 23% and Arista Network up 14%. Those are the biggest semiconductor data center gains today.
Oscr down 3.8, Novo 2.5, Applied 2, Micron down. Uber is down because they just had an amazing quarter. So that's why. Makes sense.
Makes sense.
Makes sense, yeah. What else? Who is green? AST is
Snap
green.
down 22%.
That's normal.
Wild.
Iron is up 2.8.
Supermicro down 18%.
Google is down, 0.2. Reddit is up 2%.
GitLab is up 2%. Reddit's been just on a roll.
Yeah, maybe the people on Reddit should start pumping our stocks.
Reddit people get on Applied.
So yeah, we have here exactly AMD at the 20, now down 5.5%. SMCI down 18 or so. SMCI down 18. Let's see what open. What do you think? Open. What did they open at?
Down.
Yeah.
20%.
How much? 20. 20%. Ching, ching, ching.
Nailed it.
Bravo.
Nailed it. Going to the casino later today.
You get one share. You get one share.
What is that, like $2? Not even?
Exactly. It's one super chat. Shop is up
killing it. Nice.
20%. Very, very nice. That's insane.
Trade Desk is up 2.5%. I guess the excitement from Unity may be producing some advertisement growth outside of just your typical Meta.
They report
I know
tomorrow.
one of the things for Trade Desk is they were shifting to an AI platform as well for some other advertisement solutions, very similar to what Unity did in their own market way. But it was more of a shift to a more AI style based technology. So if Unity is seeing kind of that traction from their AI based technology, then maybe Trade Desk could be seeing it as well.
Plus all the comments that we heard from Meta and all the advertising plays. Uber is down 1%.
Yeah. I don't mind this, just chills.
Yeah, remember ridiculous. You said A-Lab is up 27. Wow, that's
wild. Yeah.
Impressive.
Impressive or scary.
Yeah. Oscr down now just 1.5, so we have some buying action happening right here. Novo is also down 2%, seeing some small buying activity. Coinbase keeps dropping, although it's flat right now. Well, that stock got slashed. Down 32% since what? Not even a month ago. That's interesting. United Health recovering a little bit by not much. Snap is also down 20%, now at $7.50. Yeah, CRM.
You guys do one, Neil?
A video about them? I think I'll wait until they
CRM.
report. But I did mention them in a undervalued stock video because it is undervalued. It's not a fast growing company anymore, but it's a very profitable one. A very, very profitable one. So Novo is down. Let's see, Eli Lilly down a little bit, but they report tomorrow. So I guess, yeah, Florian here says hopefully they'll move on the upside for whoever owns it, but we'll get more of a market reaction, I think, tomorrow when Eli Lilly reports. But AMD, okay, no, seems like AMD has been recovering above that 20-day. So we're at 165, which is fine. As for the rest, nothing too crazy. Reddit up 4, Iron 2.6. Oscr is actually green now. I like that. I like it. PayPal is green. And Uber has turned green now a little. No, wait, why is it saying? Well, depending on the seconds. Depending on the seconds. So Google is flat to greenish. Okay, so we can end it. We can end it with Uber being flat greenish.
Sounds perfect.
Yeah, and Open is at $2, so it's down 20%. I did make a video about it, so whoever wants can go on the channel and check it out. Yeah. Quick video. All right. With that, we will
see you
be
guys
back
tomorrow.
Yep, bright and early, extra early actually. For Nebius, for some Nebius
yes.
earnings action. So make sure
Are you
have.
confirmed on guest, Neil? Is it 2 still? Is it 1?
It's definitely 1, but could be 2.
All right.
I'll schedule and sell the links out later today. All right, guys.